Hello everyone, I'm Glenn Hamilton and welcome to today's podcast in association with Unique Manager Showcase. My guest today is one of the most interesting, successful and forthright individuals in the asset management industry. Alan McFarlane founded Dundas Global Investors in 2010 and since then they have consistently delivered superior returns across all their institutional mandates and 2 wake funds. At the very heart of what they do is sustainable dividend growth investing. And as you will hear, that is a strategy the whole team is incredibly passionate about. We discussed Alan's fascinating life and events that shaped his career and thinking. But we also found time to discuss how he once learned to fly a helicopter, the cost of petrol at Costco, and the difference between a caravan and a motorhome on the Isle of Mull. So please sit back and enjoy Alpha Seekers with Alan McFarlane.
I do want to talk about how you got into the industry, but I think let's start by going further back because you had quite a humble upbringing.
So I was born in the 1950s, and the cohorts born in the 20s and 30s and 40s lived through the cataclysm in World War II, and some of them would have lived through the Depression in the 1930s. But the generation that I'm part of has been written about extensively, and we got the benefit of much improved investment in education, much improved investment in healthcare, the benefit of treatments, pharmaceuticals and others, better childcare, a whole range of things that have led to this explosion of improved circumstances.
Yeah.
Doesn't feel like it today with inflation and the problems we have. But viewed through a longer lens, that generation has lived a gilded life in this country. So really, your gentle characterization of humble beginnings, me and millions of others, our parents had a big step up thanks to the war years. And that generation gave us a bigger step up in the post-war era. So lots of my friends, lots of my professional acquaintances and people we know experienced that escalator that the welfare state and economic growth after World War II provided.
Yeah. What did your parents do for a living, and what values did they instill on you that you still hold strongly now?
My dad had trained as a moulder in iron foundries, and shortly after I came along, he was made redundant at the beginning. So that the Glasgow iron foundry industry started to shrink along with a lot of UK heavy manufacturing after World War II, and he was at the sharp end of that. So he then worked in a cardboard box factory. So I was always, whenever people were moving, I was always their best pal because I could get hold of some cardboard boxes.
And you had dens to build as well as a child.
All of that. And then my mum, she, like a lot of people, she'd left school with functionally no qualifications before World War II. But World War II gave her the chance to enter nursing. So which she seized with both hands, an immense pride to her. I was an only child of 2 working parents. And what did they instill? Nothing particular that I think anybody else's family wouldn't have had. Just a sense of you had to work.
Yeah.
They would have been terrified to be unemployed. I think, I was an infant when my dad lost that job. But as I got to know him as an adult, I can see that was a terrifying moment for him.
I bet it was, yeah.
And a sense of loss of identity as well, that he'd been this, very mid-20th century, very male, physical activity. And he then went to do something that involved tending machines that folded cardboard. So I think they were both workers. So if you're asking me, the thing I got from them was you work.
Yeah.
Me and millions of others.
Yes. And you mentioned politicians there. I mean, you were at Edinburgh University and studied politics and modern history. Good time in your life?
Loved it. Transformational. And again, I would put that alongside a lot of people I know. So I think when I went to university, I think 7% of an 18-year-old cohort would go to university. A larger percent would go to colleges and do professional training and HNDs and degrees. That's all been changed now because almost all those colleges are now universities. So I don't know how comparable the numbers are. But certainly there was a sense that the doors were flung open and that up here in Scotland, if you passed your hires, the door would be open and you'd get financial help. There were no fees, or if they were, the local authority paid them. And we got grants to go to university. We didn't get invited to borrow money. So it was different times, but there was a sense of a wide avenue opening, and it was great. I loved it. And I loved what it provided. I love what it provided.
Yes, yeah. And on leaving university, I understand you went to work. Your first job after leaving education was in local government. Tell me about your experiences there.
Well, I'd applied for the civil service fast track program and got right through to the final group and gave the worst interview, perhaps almost as bad as this one, and wasn't selected.
Fantastic, Alan.
And wasn't selected. But my tutor put me in touch with the local regional council. The entity doesn't exist anymore, but let's call it the Edinburgh Lothians region. And they were looking for someone to work on policy research. Now, this is pretty nerdy stuff, but I was fascinated by that. And I did that for 2 years. So working on things like the declining birth rate and its implications for school places relative to the rising proportion of the population in retirement and beyond, and who would need social care. So we're discussing that today, and we were discussing it 40 years ago. So it was an interesting time.
So what made you
very interesting?
So great time, interesting, fascinating job. What made you want to leave there and come and work in the investment industry?
It was a bit slow, and if you provided an input, let's say a paper on a topic, it could be 2 or 3 years before that came to fruition. And I am deeply patient and very impatiently so. So I'm happy to play the long game, but I like to see things happening. And I was at an event where a chap I knew from a university through in the West, he was talking. He joined an investment bank called Wardley, which was part of the Hong Kong and Shanghai banking organization. Yeah. He talked about what he did for a living, and I thought that just sounds gripping.
Yeah.
And so I applied for and got a place in what's now called 3i Group.
Yeah, it's private equity.
But at the time, it was partly owned by the Bank of England.
Okay.
And the clearing banks, and it was an investor directly in private companies, so not listed companies. And it did venture capital and private equity, as it's called today. I was fortunate to work in the office that addressed the Lothians and Fife and the borders. So my entry into this business was in 1980, when Thatcher was already Prime Minister, Geoffrey Howe was already Chancellor, and those 2 or 3 budgets in a row where the lady wasn't for turning led to, or contributed to be accurate, quite a tight set of economic circumstances. So my exposure to this at the beginning was things going bust. It was recessionary times and difficult times.
But probably needed, would you say, after the volatility of the 70s?
Needed is a strong word. It was one interpretation of how we could get out of that problem. Others were available. There were successes. The biggest thing was interest rates went through the roof. Now, that wasn't entirely a British feature, because Volcker at the Federal Reserve had determined that they would get inflation down by pushing interest rates up. So, and it was the period when the independence of central banks in respect of inflation began. There were ugly elements, but goodness me, it was fascinating. What a time to get stuck in.
Yes, yeah. And you were there so the company that was to become 3i, it's in private equity, you were there for about 3 years, and then you moved to your first role in actually managing global equities, which obviously you do now. What lessons did you learn from those early years of when you first started managing global equities that still hold good now?
Well, the key thing about the first bit, the 3-year bit, about learning to invest in private companies, is there was no market for their shares.
Yeah.
So you were making investments of an unknown duration, hopefully very long term. And therefore, you had to make the investment based on the company's prospect. Now, the gentleman who got me into what I'm doing now, a chap called Ian Rushbrook, some of you listening to this podcast will have heard of him. And he'd navigated the 1970s, and really 2 big issues there. One was inflation, and the second one was the technology boom. And he wanted to bring people in whose background was investing in private companies. So we both joined Ivory and Syme to bring that approach, that very long-term approach. Well, Ivory and Syme had that anyway. We weren't pushing in a closed door. But what stayed with me ever since is precisely that. You're buying a share on a stock exchange, but it's a share of a business.
Yes.
And over the years, I realized that a lot of people were putting their trust in their ability to call the direction of travel of a share price over 3 months, 6 months, 1 year, 2 years. And I've met people who did that quite successfully for a while. But that's ultimately a loser's game, because I suspect it's closer to divination than it is to analysis. And so it was great to join Ian Rushbrook at Ivory & Sound, who said, I want you to do what you've learned to do in the last 3 years, and I now want you to apply that to investing in public companies. And that has never left. That confidence that what you're investing in is a business.
The 1990s, you spent most of the 1990s, if I'm right, saying based in London with GAM. I mean, how was that? Because you would have had a young family at that stage. How was that transition? What were the challenges of bringing your family from Edinburgh down to London?
Well, it's still the same country, despite what some politicians do. So very happy to have done that.
Yes.
The big change there was that GAM's name, Global Asset Management, and for those of you aware of how much difficulty it's been in recently, this was the GAM under the leadership of a remarkable individual called Gilbert de Botton. And what he wanted, GAM was a wealth manager, and what he wanted was to retain and grow that business, but he wanted a business with institutional investors, charities, pension funds in particular. And through the good offices of someone that knew both of us, I was introduced to him and asked if I would do that. So it was great. Blank sheet of paper in your mid-30s. And that business, by the end, had clients in New Zealand and heading westwards all the way to Vancouver, and many, many places in between. So lots of air miles. That was a glorious opportunity and a fascinating time, because by that stage, the pension fund, this is exciting stuff, isn't it? The pension fund industry globally, almost no country had enough diversity in its stock market to provide the economic exposures that those pension funds would need if they were going to fund people's pensions for the next 60 years. So they had to invest globally. And the clue was in the name, Global Asset Management. So that we provided global portfolios, international portfolios, a whole bunch of things to those pension funds. And got to meet people in all walks of life with enormous responsibilities for these pension plans and see how we could help them. And it was great. Yeah, it was pretty intense.
And in 2001, you returned to Edinburgh as the CEO of Walter Scott and Partners. How was that a role change? How did that change the dynamics that you're not just managing money now, but managing people, managing an entire business?
Well, I didn't join as chief executive. Walter and I, another remarkable individual, we shook hands. That was already a successful firm.
Yes, I stand correct.
And he'd been at Ivory & Sound. It was already a successful firm and it was well established. So when I came back, I said, let's do this. And so we had a brief probation period, and then I became chief executive and ran the business. And that was
how long was the brief probation period? How long was it before?
About a year.
Okay,
about a year. But the point of that, the point of your question is, or rephrase it. What I take from your question is, there's a moment in the industry where you have the opportunity to knit together running the company, organizing its resources, directing it, pointing it, being involved in the investment decision-making and growing it. And so it would be, instead of a conductor of an orchestra, it's like some of those bands you get where the pianist is leading the orchestra. They're playing and leading together. And I was in my mid-40s, and I felt as if all my training had come together. Yeah. And here was a chance. And then all of that was put to the test, not for me, but for everybody in that firm, when along came the crash. But the bit before the crash in 2007 was that we'd become very skeptical about most of the world's banking industry. In 2005 and 2006, financial stocks had become the biggest group in indices worldwide, and being absent them was an enormous handicap. And so we were lagging indices and lagging competitors, and the pressure was on our communication. That was great fun.
Well, wasn't that around about the time there was the acquisition by BNY Mellon?
Yeah, it was acquired. It was Mellon Bank, and then within about 10 weeks of Mellon Bank acquiring that firm, Mellon was then the junior partner in a merger that created BNY Mellon. You're correct. So that was a bit of extra pressure.
Yeah, I was going to say.
It keeps you on your toes and it keeps you alert. If you don't find that stimulating, go and find something else.
Yes, I agree.
But I loved it. I loved every minute of it. I didn't have a day I didn't want to turn up to work, because one of the things that happens, and you'll have seen this in managers that struggle, managers that underperform, not always, but often, that underperformance is because you have a profound difference of view with the market consensus. And by the obligation of client service, you have to go and talk to your clients and explain your position.
Yes.
Now, if your position is weak, it will melt under that, in that temperature. But if your position is accurate and you find that the arguments that you're advancing for that position, you're resolving at the end of the meeting, yeah, I came in, I believe this already, but I've been asked 4 really good questions here. Your resolve grows.
And then in 2009, you set up Dundas, founded Dundas. I mean, what drove you to that decision?
Just to get the dates accurate. So my contract with the organisation that bought Walter Scott and Partners ended on the 31st of December 2009. So we just had the joy of 2007, 8 and 9 and navigated it. We were still afloat and going in the right direction. So that was satisfactory. And I thought it was time. What was there to do next?
Yes.
We'd been through all that, and there were very capable people at Walter Scott who could take over. So I thought that, I'd said my lines, it was time to get off the stage. And Dundas, in a sense, is indulging an itch. And the itch is not autonomy. The itch is going back to the baby boomers that we talked about at the beginning. But 2011 was the year in which the first baby boomers turned 65.
Right, yes, yeah.
Populations were rising, workforces were increasing in size. And so the number of pensioners was a fraction of the number of people contributing into these pension schemes. Now, I'm not an actuary, but I've got a reasonable grasp as to how the financial dynamics of these things work. The trick in actuarial maths about pension saving is that when your money goes into the pension pot, it buys assets that generate dividends, and those dividends are retained to buy more assets. So most of us never see dividends for 30, 40 years of our lives.
That's right, yes.
But they're working away in the background, compounding our savings. But when you hit 65, particularly in a DC system, you have a lump sum, and that lump sum has a dividend stream and it has a capital value. Experience suggests most people have an inner actuary. They work out when their parents passed away, look at their own health, and they work out how long have I got. And some of us have got decades after we retire in our 60s. So long-term investors who need to consume those savings, and you get a regular check, the dividends from the companies, never seen them before. They don't come through the stock market. They're not listed in a stock exchange. Disney's dividend, well, it's not paying one just now, but Visa's dividend comes straight to you from Visa, takes you all the way back to investing in private companies in your early 20s. You have to analyze the company's ability to pay that dividend, and then people will consume their savings over time. So I thought we were on the cusp of a change in capital markets, and I still think that. There's been some bumps to contradict it. The COVID era and the monetary policy that was applied to get through that. But more and more DB pension schemes are moving towards being cash flow negative. Even some defined contribution schemes are starting to be cash flow negative. And so they've got to manage their dividends and capital in a way that perhaps they didn't before. It's immensely important because that is the best milestone to indicate the growth of the company that you're investing in. And if your dividends keep rising faster than inflation, you don't need to sell as much of your capital year by year. And people are so risk averse when they get into that position. So I thought the world really didn't need another global equity manager. There were plenty of good ones. I'd just left one, and there are many others. But I wanted to scratch that itch and see if we could build portfolios based on dividend and capital growth disciplines that would be useful to clients, not just in retirement, but useful to clients as they accumulate their savings as well. Now, that's a bit wordy and it's a bit waffly, but the reality of an aging society is unarguable. And the amount of wealth in the hands of that cohort, likewise. And how are they going to invest it? Are they going to bet the shop on Tesla? Are they going to bet the shop on some Chinese semi-state-owned variable investment entity? Maybe they are. I think a lot of them are going to want to buy stocks with sustainable cash flows, exciting growth prospects, maybe not at the speed of some of those other things, but who can pay dividends that rise reliably above inflation.
And Dundas is famously all about investing in those companies, the companies that pay dividend growth. You have that exclusively, that one investment strategy, dividend growth.
That's all we do.
You're not known for launching lots and lots of funds. You've had to focus. You've had the Heriot Global Fund for which fantastic performance over the last 10 years. But then fairly recently, just over a year ago, you launched the Heriot Smaller Companies, Global Smaller Companies Fund. How can you replicate the performance and the strategy that you've done so successfully for the last 10 years in the Global Fund to the Smaller Companies version?
Well, just to pick up one thing before I answer your question, I mean, we've been called Dundas Global Investors. Maybe we should have called ourselves Dividend Growth Investors. So in fact, we use that more often. So DGI, when people think of us, we'd love them to think of DGI being Dividend Growth Investors. And you're right, we've done that in the Heriot Global Fund, which has held Microsoft and Apple at various times, which have been literally multi-trillion-dollar businesses by value. But we've also invested a lot of our clients and our own savings alongside our clients in businesses whose capitalizations are from $5-6 billion and up. So in fact, I don't like being asked, and you didn't ask me, so thank you. But I'll now tell you the question. I'll now tell you the question I don't like being asked, and then I'll give you the answer I don't like giving. But it may be illuminating. The question I'm asked is, what's a typical Dundas stock? I hate it.
Yeah,
because that implies exactly, because it implies that we know what we want, when in fact the world presents itself to us. We don't impose on the world. We select from what's available. However, there is a pattern that typically our portfolio is, its weighted average size is a bit smaller than the weighted average size of the indices or the constituents of the indices. And secondly, the businesses they're far from mature. So they have years of growth ahead of them, profitable, and they reinvest most of their profits to fund future growth. So their dividend is the residual. It's not a high payout stock like a Vodafone or a Shell or a bank or something like that. So that's the background to that. And to answer your question with smaller companies, we've done the work. We've done all of our own research over a 12-year period. We had a library of our own work on well over 1,200 companies. And we don't use broker research. We don't use bought-in research. We just do all of our own work based on published materials. And during lockdown, the opportunity came just to go back through that library without having to come to the office. So you could use every hour in the day. So we turned the spotlight on the library of what we'd accumulated and discovered that just under half the companies in it were under $10 billion in size. Now, that's a huge business to you and me, but in market capitalization terms, you're down at the smaller companies end. And so a lot of work was done on those 500 or 600 stocks. We got it down to 125 that looked really interesting, gave it to one of our colleagues, Gavin Harvey, and said, shake it, stir it, kick it, push it, punch it, sift it, come back and tell us if there's a portfolio inside this. And he said, there is. So we began from our own research. We didn't go out and look for extra companies. We began from that which we had already discovered. And we were already researching. So all we've done is we've made available the fruits of that research with a focus on companies. I think the average capitalization is about $4 or $5 billion. So it's notably different from Heriot.
But not tiny, smaller companies. It's important. These established businesses.
They're not microcaps. No, these are established businesses. Yeah. Yes, these are established businesses. And we've been doing it for a year. There's a couple of questions have come up about how we do it in the future. But here's the main thing. Markets are full of prejudice. They're full of cliches, or the discussion. When I say markets, what I mean is that all of us are active in it. All the bloggers, the FT, the Wall Street Journal, podcasters like us today, all of this debate, this chatter, Mr. Market, it's full of opinion on a range of things, some of it informed, most of it not. All I can say to you just now is a year and a quarter in to the Heriot Smaller Companies Fund, I am more convinced about the value of a dividend growth discipline in that category of company. And we're already seeing it in higher dividend growth rates compared to Heriot Global. Now, there's more risk because these companies are not as well established as Disney or Microsoft or Thermo Fisher. They probably need to reinvest more of their profits. However, the initial hurdle, namely, does dividend growth apply? Yes, it does. And we've been through a number of reviews already to sharpen and apply that. So, two funds in 10 years as you can see, we're marketing led and desperate to throw funds at potential clients all the time.
I mean, I've looked at that fund and I agree with you. I think it's a fantastic fund. And you mentioned earlier about, a good business is based on having good clients. Well, you've certainly got one in me. What are your ambitions for Dundas? Where do you want to take it?
Well, the number one is we have to deliver performance to our clients whilst maintaining integrity. And by maintaining integrity, that means increasingly our compliance regime has to be strong. Our personal ethics. One of the things we try and do is shorten the distance between any 2 points that are involved in the business. So, for example, I'm sitting here talking to you about Heriot and Heriot Global. I think it's still the case that Anne and I are the biggest investors in the Heriot Fund, and I'm the biggest investor in Heriot smaller companies. So I'm not speaking to potential investors or people to whom we'd sell the fund. I'm speaking to people who might co-invest. So I don't want to have that agency issue. I just want to be alongside. So that's number one. And my colleagues the same. So what do I want to do? More of that. Number two, we want to communicate to people. So if we want good clients, we've got to give those clients something they're not getting anywhere else. And the thing increasingly that we want to do is give them the pulse beat or the pulse of global dividend growth from the few companies that we own. Let them know what Costco and Visa are doing through lockdown. So there was a point earlier this year or last year. I'm a unashamed Costco fan, and it's in the fund. It's in Heriot. And I was out at the Costco south of Edinburgh and noticed the queue for the petrol. See, I'd never used Costco's petrol before, and went back home and checked the tank size of a Ford Transit, the average petrol price in the UK in the RAC website, and Costco's price, and reckoned that a white van man filling his van twice a month after the third month had paid for his Costco membership card. So it's the opportunity to take that observation and bring that to the portfolio. So we want to shorten the distance between the real economy and what's in the portfolio. And we want to communicate that. Yeah, and we want to communicate that back to clients because they can get caught up in macro on is Xi Jinping Lenin reincarnate? Will China invade Taiwan? And these are serious and important questions. But you can get so caught up in that, you miss whether White Van Man finds Costco irresistible now. So we want to do that. And then from the standpoint of business, it will be what it will be. We will either find favour with potential investors, in which case the Heriot Fund's average fees will keep falling because the overheads will be spread across more investors, which will be great. There's a natural upper limit to this. We're not going to turn into the next name big fund manager. That's not going to happen. So we're going to stay at the smaller end. But personally, and I love this. This is great. I really enjoy my work. I enjoy my colleagues. Most days we have our moments.
Most offices are exactly the same.
Yeah, they are. And I want to see if those observations about dividend growth and the changing capital markets and demography, if that continues, I suspect we've got a fighting chance of being more right than wrong.
That's great. I could chat here for the rest of the day about the industry, about your opinions on markets, but time is unfortunately against us. Before we go though, what do you do outside of work? Can't surely be all work and caravansing on the Isle of Man.
Well, it's not caravaning. No, that would be a step too far. That would be a step too far.
Your camper van.
Yeah. If we're allowed to mention Jeremy Clarkson, I think that would be a step too far. No, our motorhome, our used motorhome, we really just got it to make it. I tell you why we got it. Yeah. I just get fed up traveling around Scotland in particular, packing bags.
Yeah.
We're going to go and play golf up at Dornoch or travel to different. I just get fed up with it. So everything we need is in that van. So it is a means to avoid checking in and checking out of hotels and B&Bs. That's the reason for it. So play a bit of golf. Look, I'm as boring as every middle-aged man or slightly youthful elderly man of my age. Blessed by family, blessed by grandchildren.
Probably don't have much time to do with 7 grandchildren, I would have thought.
They're interesting. They're all investors in the funds.
Are they?
And
surely didn't sign the application forms themselves.
No, they don't get a choice. It's juniorizers. Don't tell them. The oldest one's got an interesting portfolio now. We're trying to work out how to keep it away from her. But
Wait until she's 18.
Yeah, outside of work. You know what? This world and all that is in it are endlessly interesting.
Didn't you learn to fly a helicopter?
I did, but my license hasn't lapsed. I would have to reactivate it. I did that through the crash, literally, metaphorically. I did that through the financial crash, and probably learned to fly a helicopter in order to avoid crashing. But it was a marvelous distraction from all the torture. No, not a workaholic, Glenn, but there's no real dividing line between work and leisure, because everywhere you go, you see what's going on around the world, and then you relate it to what you're doing at work. So, yeah, still keen to keep doing this. Right at the beginning, when I was chatting to one of your colleagues, he asked me about one of our competitors, and I said, I really didn't know. And they said, you're joking. And I said, no, I really don't know. And actually, I'm surprised you asked me, because our job is to study the stocks, not to study the competitors. If you want to win this game, you don't win it by checking your league position. You check it by training to play. So every year, my professional objective is be more true to the principles that motivate us.
And I could not think of a better line to finish this on. Alan, thank you so much for your time. It's been truly fascinating conversation. As I said, I could speak to you for the rest of the day on this, and I hope that maybe 6 months, 9 months further down the line, you'll come along and be the first guest to appear twice. Alan, have a fantastic day, and thank you very much for your time.
All the best, Skyboy. See ya.
Alpha Seekers is produced by Laura Cruz in association with Unique Manager Showcase. If you'd like to hear more from Alan, there are many webinars on the Unique Manager Showcase website, or please contact us at investor-relations@dundas.co.uk. Have a great day, and I'll hope you join me next time. Until then.
Nothing in this episode is intended to constitute as advice or recommendation, and you should not take any investment decision based on its content. Any opinions expressed may be subject to change without notice. Remember, the value of investments may fall as well as rise, and you may not get back the amounts you originally invested. Past performance should not be considered as a reliable indicator for future returns. Different funds carry varying levels of risk depending on the geographical region and sector they invest. You should make yourself aware of these specific risks prior to investing. If you're unsure about the suitability of an investment or you need advice on your specific requirements, you should seek professional advice.